A week of complexities in the fundamental supply and demand situation of oil filtering now into the derivative market. In this episode, we get a little bit more technical as we see what's really going on under the hood. Not something we do all the time, but an opportune moment to do it and a very important time to do it. So enjoy this episode where we go through all the normal things, crack spread chronicles, hedge fund watch, winners and losers. But as I say, getting into a bit more minutiae and a very interesting episode. I hope you enjoy. Thanks. So as always, we want to break down the volatility, the volume, the open interest to get a sense of the market state. So Vincent, why don't you take us off? How would you summarize at the moment?
Yeah, of course. So the market state can be described as heating up. There's been a slew of headlines over the past week relating to OPEC, geopolitical risk, trade tensions as well. All of this have led to increasing activity in the market. Whilst the start of last week was a bit quieter, in part due to UK bank holiday, lower trading volumes. However, there's been more volatility towards the end of last week, start of this week.
Yeah.
And we've been seeing that in more options activity as well.
Yeah, it makes sense. Obviously, we cover the herd mentality next, but the OPEC meeting around the weekend, and I would say actually a relatively unexpected volatility on the Friday. I guess you could easily explain that by people preempting what was going to be said on the weekend. There was some headlines released that were kind of indicating things were going to get bad. We kind of chased that 60 put range that we talked about last week, where there's quite a bit of open interest on the options and things started to pick up. But then kind of after the weekend, and we'll talk about this more about what happened, not quite what people thought, and then there was a bunch of short covering. So yeah, definitely more volatility, right, you have to say. And is that in the numbers?
Yeah, I completely agree with that. So on the chart we see here, so from Bloomberg open interest on the Brent crude futures options. So on the $60 put, so on the $60 put side, there's been an increase in open interest, which means that there's more people in the market betting on that prices are going to be more bearish in Brent. That's off the back of the headline from Friday, rumors that's been floating around that OPEC will increase more than expected, more than the 411,000 barrels per day. But over the weekend, the headline was that they would be increasing as normal. So that gave a relief to the market, who thought that if it was going to be higher than expected, that would lead to a more bearish reaction.
So this is a classic example of like the market makers kind of being the key traders at the moment in the outright, because they've, everyone rushing in to buy puts on Friday, probably worried about what could happen. So pile into these 60 puts and beyond. So the market maker's got an option, right? They can just take it on, or they have to hedge it with the actual futures. And then in addition to that, as flat price or Brent was going from a kind of 63, 64 down towards 62, it's getting close to 60, which means the options that they've sold earlier at 60 are getting closer to, being like in the money. So they've got to delta hedge even more. So you've got like double whammy of activities. It's not surprising that quite a lot of volume was starting to pick up on Friday. But then, as you said, if it was the reverse of the decision and we actually, the opposite kind of happened, that the options buying was anticipating, then you got to basically reverse those hedges, or reverse like kind of a lot of that kind of panic volatility. So all kind of makes sense. But I wouldn't say, like, if you look on the flip side, if you go back to that graph, I mean, what is the market saying about week on week about thinking the market's got upside in it?
I think week on week on the upside on the call option side, there's been not so much changes.
Yeah, it's more on the puts. The main open interest.
Still on the main one, 70, 75's not too much of a change. It was just more on the $60 put options that's increased around.
Yeah, so it's just around that psychological level. It was 70 last year, wasn't it? 70 to, I guess, kind of 80, and now 60 is this like big thing. Are we going to break it and trend all the way down, or are we going to be held there? And you're seeing all the articles coming out today and yesterday, again from Shale. Shale can't survive in this scenario, and they're obviously trying to talk the market up, and it's not nice for the shale oil community to be below 16. Well, we obviously got to look at it. We're always talking about Brent, but obviously $3 or $4 cheaper for WTI. So they're really right at the 60 at the moment. Okay, and what about volume, open interest?
I think on volume, I think it's...
Yeah, sure. So
discuss this.
If you look at Vincent's chart here, on the week, you can see the front month July volumes of Brent and WTI, etc., decline. Not really surprising given the expiry on Friday. However, the global volumes traded last week fell to 14.4 million barrels, and that was about a 13.5% decrease week on week. It's also lower year on year. I think nearly 7% down on a year on year basis. So last week was quieter, not entirely unexpected given the bank holiday on Monday, as Vincent mentioned, for both the UK and US. So
this is the officials report, right?
This is our liquidity report summary table. So here we take the key futures contracts. So WTI,
the global
Brent.
total at the bottom is your assessment, including even China and all this.
Yeah, it's global traded futures. Yeah,
in oil.
Nice. In oil. Yeah, and the 14.4 million barrels is across the entire week, all aggregated for the number of barrels traded across tenors.
Yeah, nice one. Okay. This has been a bit of a trend now, I would say, right? We've had the de-risking last week. We were talking about the market being quieter in a range, but having said what we just said, actually it's a little bit surprising we're still declining.
It is worth noting, though, that we're coming off a very, very busy period because April, we saw the second highest ever monthly traded volumes in oil globally.
Oh, nice.
We saw over 110 billion barrels traded in April, second only to March 2020. So that's COVID lockdown period. That was absolute black swan mania event. And then January as well was really, really busy, partly because of the Biden sanctions on Russian shipping. So of the top 3 months of traded volumes, we've had 2 in the last 5 months. So overall, the trend is clearly upwards.
And I guess you've always so I'm glad you guys are doing this now because no one is actually reporting all volumes, right? It's just in one exchange or one contract. So the organic growth in contracts is what interests me as well. Like the financial oil market has been growing relentlessly for the last 10 years plus, but then it's still on this trajectory. So what do you know off the top of your head? I'm putting you on the spot a bit, but roughly in the last few years, you're saying it reached an all-time high in April, but was that in line with the trend or was that really a genuine spike?
I think it's a spike based on events. However, the baseline that we're coming back to seems to be getting higher every time. So we come back from the spike in January and the Biden sanctions down to a higher level than where we were before. Same in April. I think we've done the same into May trading because 80 billion barrels is still quite a lot on a historic basis. So I think that baseline is slowly creeping up as we have these spikes in volumes traded. Yeah,
okay, nice one. It also coincides with a general energy theme, commodity and energy theme of hedge funds reducing their risk. Or at least, lots of talk about departures and scaled down risk in power and gas, but also oil. So it kind of does make sense. April just basically was quite hard for some people, and then you would expect to reduce the volumes. Cool, nice one. And then the final thing, I guess, open interests, usually in line with volumes, but are we seeing an open interest decline as well, Vincent?
So on the open interest side, looking at the chart here showing for August 25 Brent futures, it's been quite flat over the past couple of weeks. So nothing too much to note about.
But steadily coming back post this April, kind of almost the inverse, right? You've had the April dramas, let's say, and the de-risking that comes with that, people losing money or some people losing money, the confidence kind of returning. That actually is what I would have expected to see a little bit more. Volumes, I can see, the volumes can be loads of reasons, right? Different hedging coming in, whatever, but open interest increasing is giving you an indication the market confidence is coming back. And I think it is just generally anecdotally, but anything else to add on that?
Yeah, definitely. I think it also shows just how much of a risk-off market there was post Trump Towers Deliberations Day stuff. So we're really seeing the market coming back and adding more risk to these futures contracts.
Nice one. So how we summarize the market state? Heating up, you kind of said before.
Yeah, I think bubbling up. Having simmering a bit last week with getting a bit warmer again.
Yeah, I agree with that. Nice one. Okay, so let's follow this on with the herd mentality. So we've already mentioned the OPEC meeting is pretty obvious. That's what's been everything. But why don't you take it away, Ed, from the official side of things? It's all been about the physical, and it's going to have to be a bit of a technical episode because of all that stuff. And the niche stuff is moving the markets right now. It's a bit fair to say.
Yeah, I think it's the OPEC meeting on the weekend is clearly the main driver that we've seen recently because we were coming in, the market was really expecting a 411,000 barrel increase per day, as we've seen the last 2 meetings before that. So that was kind of the base case. Then the Kazakh energy minister comes out last week, I think Thursday, and suggests maybe 400, maybe 500, maybe even 600. And are a couple more reports suggesting maybe more than 400. The market starts to get a bit panicky, maybe expecting more than 400 to come out on the Saturday meeting. And then, as we saw on Monday,
and you think that's what
this
was driving a lot of the panic on Friday, right?
I think it was, because people going in expecting fairly safe, they're going to do the same thing again. They've been reiterating this need for consistency and balance. So suddenly this idea they could do more was, I think, put a bit of the cat among pigeons.
Cat among the pigeons.
Yeah, put the cat among the pigeons in the market.
It's interesting as well, because I don't think it's surprising to anyone now that they release these headlines and these comments ahead of the meeting to kind of signal their displeasure with other members, or the opposite, displeasure with the market, whatever it is. So this time round, the talk, wasn't it, was that the Saudis again are getting frustrated with non-compliance again. So it's and actually that's something you raised. That was a good point yesterday. The difference between the Saturday meeting and the Wednesday meeting was quite a big difference, because one was the voluntary, one was, you want to talk about
exactly. So the normal meeting happened on, I think, Thursday, the JMMC,
and that was the safe answer.
That's the basic, their monthly meeting, business as usual. The Saturday meeting was among the OPEC 8, which are the 8 voluntary cutters. And Vincent has quite a good graphic here on the iPad, this pyramid kind of diagram to clarify the OPEC cuts, because they're quite complicated and quite varied in terms of who's doing what and why. So you have the collective group cut that is all of OPEC plus, which is 2 million barrels per day, and that's supposed to run until the end of 2026. And on top of it, you have these additional cuts by the 9 and 8 members. Now, the 9th member that isn't included in the final cut is Gabon, but they seemingly have now withdrawn from this voluntary cut, so it's a bit even more unclarity.
So did you say that is an additional unwind then?
It's 8,000 barrels per day, so it's not particularly big, but it's a little bit perhaps. But yeah, so currently what we're working through with these returns of increasing quotas is the
triple go. So you got the group cuts that's been going on for, I don't even know now, 2021, that kind of time, 2020,
2022.
Well, no, it definitely started obviously post OPEC. They're bringing it back and then they stopped again. But the point is that these 2 voluntary cuts, they're 2 separate voluntary cuts, and there's only difference with one member, which is the 8,000 barrels,
which is now withdrawn.
So for all intents and purposes, just to generically, it's around 3.8, 3.9 million barrels of voluntary cuts, and that's what they're looking at unwinding.
Exactly, that's what they're working through now. And so, with these currently 3 increments of 411,000 plus the original 110 or 115,000 barrel, I think, in April, we're just over halfway through this first increment of 2.2 million barrels of voluntary cuts. So there is still a long way to go for OPEC's barrels to return to the market.
Well, just the voluntary call part, there's a lot. Cut part, there's a lot. And then we would get to the collective group. So where are Abu Dhabi and Kazakhstan in this one? They're in the voluntary.
They're in the voluntary cuts, so they're part of the 8 members. The key members there are obviously Saudi Arabia, Russia, Kazakhstan, Iraq, UAE. So they're the biggest producers of that. Problem ones really for the group is the UAE, Kazakhstan, and Iraq, because they're producing what they want essentially. Kazakhstan's energy minister came out and said we can't reduce production, and they're 500,000 barrels above there.
And they say they can't reduce production because you've got companies like Chevron who are just out there just producing what they need to produce. But look, I mean, it's one of those things where it's gotten to, actually, I was a analyst, I think you did a podcast with Harry Chinguarian here, Stan Chart, who's calling it a mille fois of OPEC cuts, like all these layers. It's quite a nice way of putting it, but it's ultimately by design, right? That it's so confusing, and like, as you just said, like it's reducing from the voluntary, then you got all the collective, but then even within the voluntary, you don't even know what is actually being produced. And then we've had all these horror stories that Jorge's talked about many, many times about analysts being pressured not to be giving the real shipping flows and what's actually happening. So it's all just basically just a bunch of bollocks. But the thing is, I don't think it's important anyway, because you can keep going on about what OPEC are really supplying. But I think they've massively exhausted this kind of sentiment gauge of whatever production is, or whatever we say it is, you are then going to reflect that view in your trade, and therefore flat price as the sum of risk taking will be X, Y, Z. I think they've exhausted that as much as they can. The fundamentals are starting to eke in, which would be the margins, which would be the stock levels, the inventories. So I think for everyone, if they really want to know what's going on, I think it's not really worth talking about OPEC too much more now. They're always going to be playing their games. You want to be looking at the key physical indicators right now to see if we are actually oversupplied. And finally, we're starting to get a signal that we are actually oversupplied. And that would be primarily the margin sell-off, which we've got kind of back here. And I guess it's been a bit volatile. That one there, the pink one, yeah. But it's, it was so stubbornly high. And there's a big correlation, obviously, with distillates because distillates is such a big chunk of the barrel. But distillates has been under a fair bit of pressure in the last week. And finally, like all the refinery cracks are starting to come under pressure, which is what you'd expect when the crude market is really strong. The margins are really strong. They're just going to run hell for leather. We're getting into summer. This is what we were finally starting to see. If what happened, the margins kept staying where they are, and they even get stronger as crude's getting stronger on the time spreads and the differentials, that is the most bullish market you can have, right? And ultimately, from a physical perspective, like products rallying and crude's rallying and everything's still going. That means you're undersupplied. There's the only thing in the formula. So therefore, that's a good time to buy flat price. It's not going to be so perfectly correlated because there's so much noise and so much financial volumes like OPEC play on with the sentiment and all that. But now, you see what I'm saying? Is it does seem to actually be behaving more logically like an oversupplied market. So it's still not a good time to be max bearish, max short on that basis. But if the margins keep compressing, they can really, really keep going. Like Naphtha is finally starting to sell off after weeks and weeks of being stubborn. Fuel markets even started to weaken after all this stuff, but I want to hesitate on that one because that's so volatile at the moment. But it's the distillate market that's finally, as the chunk of the barrel starting to weigh down on the market, and everything can go with it. So I think it's a very interesting time, but it's also so easy to get caught up in the OPEC noise. And I don't really see the point now that they're not, well, unless they go and signal they're going to increase incredible amounts, 1-2 million barrels a day extra. Everything else is just going to be incremental and just chat, just like smoke and mirrors. And I think everyone's been told that a million times, but not really trading like that. And that's kind of how I think people should think now. And we're talking about the herd mentality here, so it's important that they get to grips with this. That was a big ramble.
Yeah.
Any?
Yeah, I think as well with the OPEC matter, you've got to consider that 411,000 barrels each month doesn't mean an additional 411,000 barrels on the market, because it increases quota compliance and domestic use, particularly coming to summer. You're going to have more direct crude burn in Saudi, for example, rather than fuel oil potentially, because that's so strong at the moment. Even if it does start to come off, you are more incentivized to burn crude because of the relative differential in the price. So yeah, you have to look beyond the headline number. It's not just a clear cut.
I've got a few questions to throw your way next, because this is still an ongoing conversation, which might be boring for people out there because it's getting a bit technical, but we have to know this stuff. But before we do, let's finish off the herd mentality, because it wasn't just OPEC. There's little snippets of other things still there. We had a big rally last week, temporary rally off the Russian ceasefire kind of pulling away, right? As in the more tensions. Sorry, no, not last week. That was this week, right?
I mean, over the weekend.
Over the weekend. So the way the media was reporting it, like traditional bigger media was saying, those drone strikes and the escalation with Ukraine, Russia overwhelmed the OPEC cuts. You could look at it like that. We'd probably say it was more like short covering because the OPEC cuts didn't really come through. Increases didn't come through. But yeah, it didn't obviously helped bullish sentiment that there's escalation again. So you have to say that's back in play a little bit. And then Iran, we were just talking about before we started, a little bit unsure at the moment as well where this is at, because it's been a few weeks where they've clearly been talking. But last night we got a little snippet about US could, it was like a tweet, US could be allowing Iranian enrichment, and then Trump coming out
on True Social and saying the opposite.
So clearly they're still talking and doing just like OPEC, right? They release headlines all the time. They have talks, negotiations. They don't like the way it's gone, so they go out and tell the press X, Y, Z. It's exactly the same, right? But what we can know from that is that they're talking. So there will be probably headlines released. So we got to keep an eye on that. Anything else on the herd mentality?
I think they've all been talking. Just seems to be a bit more extreme these days. That it's good that they are negotiating. And between US, Iran, between Russia and Ukraine, there are direct negotiations going on, such as in Turkey yesterday. So both sides are talking, but then around the media, there's going to be a lot of different kinds of headlines. Both sides they have a narrative to push as well. So it's important yes, this is what the herd's talking about, but it's important not to get too caught up with like every single huge headline and see that progress is being made, but it's also going to take a long time before something happens. So it's not immediate that we'll get a resolution. And perhaps there's also a bit of headline fatigue as well. Prices aren't
we've talked about
reacting as much to these.
But then again, it does feel like it's heating up again. I got to say, like that was when we said that last week. It was literally bullish headline, bearish headline. We moved within $1 range. Now you've got like a $4 or $5 range, and there's I guess it's around the option hedging activity as well. But you've got a bit more of a stir, I'd say. But I hear you. But it just feels people were taking the headlines a little more seriously now. They're new enough. But yeah, fair point. Okay, so now let's move to the officials. I'm going to cross to the officials here, as opposed to going, usually where we go to a different room.
For the Where's Wally?
Yeah. So let's just follow on what we were saying. So we've got the OPEC situation, which is, let's just summarize it as the voluntary cut 8.
Yep.
Bickering, smoke and mirrors about who's doing what. A new big play was this, a new big factor is what the Abu Dhabi government actually produce and what they're using. Could you just talk a bit about that?
Yeah. So a lot of the talk recently in Dubai and the Dubai pricing mechanism has been about Murban, because Murban is a lighter grade of the Dubai benchmark basket. So compared to Upper Zakum, it's lighter. It's still quite sour. So normally you'd expect that to price higher than Upper Zakum and the others in the basket. However, recently it's been pricing lower and therefore setting the Dubai benchmark. That's partly because Upper Zakum yields a high volume of fuel oil, which has been really strong, whereas Murban's more of a gasoline producing crude. So ADNOC doesn't really like that because it's kind of its flagship, more valuable crude. And when you have Murban setting the benchmark, that means you have to price, because they use the Murban IFAD futures to price their OSP, you then have to give Upper Zakum a premium over Murban, which isn't very popular among them. And it's kind of coming back to bite them with inclusion of Murban futures on IFAD. However, yesterday it came out that they've revised their export schedule and forecast for Murban. So it had been, over the next 12 months, staying pretty consistent around 1.75 million barrels per day. They've cut that to drop towards 1.5 and then build back up again towards next spring. So what we've seen as a result, and then probably to export more Upper Zakum instead, as they can take advantage of the stronger pricing with fuel oil still being quite strong. So what you saw yesterday was Murban prices jump in relative to the other crudes in the Dubai benchmark. And that means that what you'll see is probably Dubai strengthen, at least in the short term, because the pricing of the lowest value grade has increased. However, longer term, if you see more Upper Zakum on the market, you'll probably see more fuel oil available because the refiners are producing more, which will then bring down the price of Upper Zakum.
We've got our crack spread Chronicles coming up, refiners, but it feels like it's all blending in this episode. But it's really important because, Murban's been setting the big benchmark in Asia and in the East. And, it's actually not too dissimilar from the grades in the North Sea, like 40s, for example, 40s versus Murban. Yeah. Switch is a common thing, very sour kind of medium grades. So that's been happening. But then it's, as you just said, so the Brent versus Dubai, it's essentially kind of like 40s versus Murban, or WTI Midland versus Murban. Yeah. And that's been rallying, right? And it's all quite logical. And then more OPEC supply means a weaker Dubai relative to Brent. And that's all been quite logical. But it got to a certain point recently where it probably shuts off the arbitrage going west to east, or disincentivise imports from West Africa to east and things like that, things that are priced off dated. So cool. So we kind of reached an inflection point. But now we're saying, okay, now we've taken out Murban effectively, right? That's going to be locally produced, locally ran in Abu Dhabi refiners. They're going to now switch that out for the crappier grade Al Shaheen. So that now sets Dubai. But this is why the fuel market has been so important this year, because the Brent Dubai economics are also a proxy for, light versus heavy, like basically gasoline versus fuel, gasoline naphtha versus fuel and distillates. But fuel's been so relentlessly strong that it's kind of like, you don't know what to think. If it's going to keep lasting at this high levels, then Al Shaheen stays really strong, which means Dubai stays really strong, which means you kind of want to be short Brent Dubai after having a decent rally. But on the flip side, if it's now out on the market, you have that lead lag situation where Al Shaheen has now ran in refiners. The key thing is they export Al Shaheen. So it's available cheaply or is available for refiners to buy and then yield products. So you have that lead lag of buying the crude, running it, then yielding the fuel. But that will take at least a month, maybe two.
It will take time,
And then a few months to build an oversupply. Does that then cause a fuel sell-off that kind of deteriorates the whole margin? But then if it deteriorates the whole margin, then you're back to that situation for refiners to go, well, do I want the lighter grades? Do I want the heavier grades? What does that mean for Brent Dubai? And are OPEC going to bring back more supply? Because if they do bring back more supply, that's more of this heavier stuff. So if you're a fuel oil trader right now, you've enjoyed, I think the market started to buy into these relentless rallies and they've done quite well in the last few months. What do you do now? You've got the Q3 peak demand, as they like to say, air conditioning, shipping, fuel demand, all that kind of stuff. But this could be an almighty collapse. If Al Shaheen's now available, it's filtering in more stocks into Fujairah, the kind of all the strength has been in Eastern fuel. It's a very important time fundamentally. And usually we're not really big on fundamentals. So we tend to talk about the flows and positioning. But to me, this is super interesting. And I think it's an inflection point. I mean, you get what I'm saying, right? Anything else to add on that?
Yeah, I think we did a video last week on the impact of crude pricing based on their yields. And it does come down to refinery economics as to what you want to buy and what crude is valuable. So, as you say, if you have a strong margin for a fuel oil and you have a crude that produces and yields a lot of fuel oil, then that crude is going to be more valuable because the refiner can make a bigger profit based off their margin.
But then the market's going to be tested by all this supply going to come online because
then you've got the supply and demand dynamic because the demand of that heavy crude will bump the price of the heavier crude because it's producing more of these valuable products. But then you increase the supply of Murban and that drops even further. Abu Dhabi cuts back on its Murban exports, Murban rises. And then as you get this incoming glut probably of fuel oil drops and you end up with this kind of seesaw motion between the different grades.
But that's the thing, it's a very important thing to say because the seesaw could go either way. So you could look at it another way and say the tight fuel market is indicative of the real, again, going back to what Saudis are indicating and OPEC are indicating versus what's actually happening. It could be indicating they are cutting quite a lot of supply because the fuel oil is just not there in the market and the fuel oil isn't being produced. Cool. So we'll probably talk about the refiners in a little bit, but let's now move to the hedge fund watch. So Vincent, more to the actual active players here with the hedge funds. What's been going on?
Yeah, sure. So on the hedge fund side, we got a couple of headlines as shown on the screen. So things like Citadel, Asia, all extending yearly gains amid volatile markets. So at least from what the wider mainstream news is reporting, a lot of the hedge funds probably have done quite well in the past couple of months, in part due to this volatility. At the same time, Goldman Sachs came out saying that in November, last week, hedge funds have been buying stocks at the quickest pace since November last year. So potentially showing that since the tariff drama of Liberation Day, there's been the market's been more risk on with these equities. That's just a wider market, I believe.
There's definitely a dichotomy there, right? Because we know that's not happening in energy and oil. There's declining open interest from hedge funds. I think we're pretty confident in saying that, but we can look at obviously the CTA information and all that. But either way, increasing confidence in the market, fine. Increasing confidence in the market for the industry, but hedge funds in our game, I would say definitely not. But we keep saying this every week, so we need some new news.
Definitely in our industry, it's a difficult one, I suppose. I think Ed was mentioning that a lot of people coming in and out of funds, maybe some desks aren't making as much money, maybe in part due to volatility or because more people go into the power and gas industry, right? And then because of what happened in 2022, 2023, but with more saturation, all that, less profits to take.
I think it's also partly down to random volatility. It's been the Trump indicator, right? It started to wane a bit now with the headline fatigue with Trump's tariff announcements. They don't seem to have as much effect anymore, but it's very difficult to trade when you put a position on, then Trump comes out the next morning saying something completely ridiculous. And
and I think if you talk about power
or
a bit, that plus like the wind has been zero for the last 8 months, and it's something like 0.0002% probability this was going to happen. 8 months of no wind. It's genuinely like complete black swan. And so this is the kind of volatility you can't really do much with. You'd have to be a bit of a nutter to be making money, because you're just buying randomly when it's low, selling randomly when it's high, indiscriminately. And that's it. Whereas people are obviously trying to build narratives around what's going on, using their information, their edge, and none of it's really been useful because it's just so random. It's a good way of putting it. But we have heard some of the classics like Onderon's pretty down quite significantly, being long across the board. Commodities, I'm sure more of that will filter out later on in the year. We'll get more information about how funds have been doing. But some of the biggest hedge funds, they're all having quite significant departures this year. But I guess again, we don't know the exact information, so we can't really say it until it's public. But what about the actual positioning in oil, like the CTAs and the FTC?
On our chart here, so the CTA model showing at least that the CDAs are still very much net short on the Brent futures as well as the oil futures and the oil futures benchmarks. What this means is that with that price in the low 60s, and with funds are already pretty much net short, there's not too much of a room to go to push prices below 60. But at the same time, if there was a reversal to the upside, if there were bullish catalysts, then there could be more room to go up, as we saw with the short covering on Monday with Brent futures like gapping higher in the open. So I have this chart here coming from Flux on Brent futures. This shows a nearly $2 gap on the Monday morning open. So potentially because the short covering flows were precisely because more of the market were on the short side. So perhaps like...
Is this not the rolling as well though?
No, this is August.
Oh, this is August. Oh, okay, yeah, that is a significant gap up. Yeah, fair enough. Okay, great. Let's now move to the crack spread chronicles. So this is the refinery margin section. And again, we've talked quite in between sections this episode, but for good reason. So how do we follow on what we were saying? It's again about the fuel oil market. We've had a big margin sell-off, margin compressing because the product prices have weakened relative to crude, and the dated component has rallied as well, which is all very logical. But if it keeps going, we're going to start putting refinery margins under pressure now. So anything to indicate that this product market is just going too far, or what's your overview that you're going to give?
Yeah, so as you guys mentioned earlier, the European refinery margins have come off quite a bit over the past month by almost $2 from $97, and this comes alongside like more weakness in the gasoline and distillate cracks, and also weakness in naphtha and fuel oil seemingly coming off a little bit as well from these all-time highs. And what we also saw recently was the data market has been quite strong as well. So there could be a lead lag effect or the seesaw. So as refineries, they buy more of this crude, they produce more, then that could weigh on margins as well. And also recent strength in data Brent, that has also pressured the European refinery margins too. So what we could see was that previously margins were quite strong, as refiners rushed to produce for summer, then that would lead to more production and potentially an oversupplied market. So we're definitely, in my view, going towards a more of a bearish trend for the margins.
And I would follow that up because we've been talking the last couple of weeks since we've introduced this of utilization rates coming up, and refiners getting quite serious about profiting from these moves. And again, I love the word seesaw. It's obviously the theme of this today's episode. But you've got great margins, but they need to be sustainable for quite a long time for them to either be hedged or for there to be a more positive outlook. And then refiners start really ramping up and really kind of going for it. Remember, these are real people, real operations that need to be ramped up, and they can't just switch it off again. It's not like a swing production, like literally turning off the tap. There's a lot of people involved in here. If you reduce your operations, you've got to lay off staff, lay off contractors, and vice versa, you are higher than when you want to keep going. So if they're now ramping up, which we think they are, it's going to take a lot to slow them down. And with margins having been so strong for so long, and we know there's been more refinery margin hedging, like a good indication of it a couple of days ago, was it Tuesday? Yesterday, was every single crack was coming off. So that doesn't really, that's not a typical thing. You tend to, when you trade a margin, you tend to basically get decorrelation between the cracks. But if every single one to come off is a pretty big deal, and is indicative of refinery margin hedging across the board, but also maybe just generally the kind of bubble being burst, or people starting to really realize what's going on. So that, in conjunction with refiners now getting into like their peak and really going for it, it's kind of like the wrong time in a way. They're coming in as things are starting to weaken, but it does make sense because the production should be coming from them. So Seesaw.
I'd like to add to that as well, that from conversation with some sources, the amount of refineries in maintenance in Europe has dropped from, they saw in May, like 1.9, nearly 2 million barrels per day in maintenance, to like 0.75 million barrels per day in June. So there is a significant amount.
And by the way,
significant amount.
That's only like 2 days into June. So it's going to be a pretty big deal. Yeah,
it's coming. There's a lot of product capacity coming on.
And that's just Europe.
That's Europe.
There's 1 million barrels per day of product coming online. Okay. And the most vulnerable in Europe, again, would be fuel oil and gasoline, Naphtha maybe. So yeah, all kind of logical sell-offs, and super interesting time. So did you have any other things to add to that?
So with the dated stuff, that's a small spoiler for the gold rush. But it was said that with how fuel oil was so strong recently, also perhaps because of the fact that around the world there's been more like development of complex refineries, which favors the use of fuel oil as a feedstock rather than directly producing that. Whereas more simple refineries, CDUs, they tend to pump out more of that fuel oil, and also with European refineries, more of them closing down, that has also created very much a shortage in fuel oil globally, in addition to like seasonal demand power generation in the Middle East.
So it's been a perfect storm.
Very much a perfect storm.
But it's the perfect storm, it's been there for a while. And then that's the classic thing about economics, right? Oil traders react. And if it's been there for a while and people bring fuel in to profit from this, then that's when you get the glut quite aggressively.
Yeah.
Right?
So in addition to refineries coming out of maintenance, they're all going to be looking to produce all that fuel oil. So very much so there could be a glut coming on. So
why are you laughing?
Maybe.
Is he short? He's short fuel oil.
Sure, could be short. No,
hilariously bearish. Well, you did your Woo Fridays episode where you were saying, you were pointing to that, right? Like it's so that's the refiners are going to be blazing that shit all summer long. But yeah, no, look, it's really, really important, because in isolation, it's interesting because people are making a lot of money, and even consumers are making a lot of money because they hedged quite a bit lower. But it really changes the whole dynamics, which I think we've emphasized hopefully quite well. So going forward, utilization rates in the States and probably Europe with the lack of maintenance now and peak summer should kind of get towards their peak. So what do we keep an eye out on for? Inventories, right? We've got to look at inventories. And I think you were showing just before the episode, Vince, we can get it up again. The EIA stocks are really like on their seasonal lows or historical lows in pretty much everything, crude and products. A good indication that we genuinely are oversupplied. Like the real question, are we, rather than what's been said to us by analysts and OPEC and all that. Inventories is the best gauge of that. So that's going to be the one to watch, I would say, going forward on this refinery situation. Okay, now let's look at the movers and shakers in the market. What's been making money, what's been losing money. Let's start with the gold rush. So making money, Vincent, who's been making money?
Making money, gold rush.
What's been making money?
On the dated market, the DFLs, as on the chart here, we could see that there's been a huge...
You love saying dated. It's, for the audience out there, dated Brent, right? So you've got Brent. And then dated Brent is like the more spot market for Brent. It's the more physical linked market. So yeah, go on, the dated Brent market, yeah.
More, on the dated Brent market, the North Sea physical, there's been a spike in prices. So this is looking at the Belgian contract. So rallying up till from 70 cents last week to $1.70 this week. Huge spike. How do we know that? People have been making money. Well, as of last week, was said, speaking to a couple of traders, that a lot of players were more bullish on the North Sea on the paper market side of things. So buying into the CFDs, buying into DFLs, and a lot of people were waiting for a rally in the physical. They saw the refineries were coming out of maintenance. You had the physical differentials were in the negatives for a couple of weeks in May. So there was very much a perfect storm for a rally. And in the last couple of days, in the physical window, Total was coming in to purchase cargoes. And yesterday they bought 3 cargoes in the window. So the differential has come from like -40, -30 in the last couple of weeks up to into the 60s yesterday. So that's been a huge spike, and the bullish people in the market have been, we could say, well rewarded in the last couple of weeks.
Yeah, I think to back up what you're saying, Q3 summer kind of contracts seasonally for the last 5 years have been the strong return, similar to gasoline. So I think we knew that the dated Brent market, the North Sea players, had been getting long Q3 for a long time. So as you say, getting rewarded is for sure on the cards. So then it begs the question, where are they getting the sell side liquidity from if everyone's buying? Well, funnily enough, you actually, you can get it from other sides of the curve, and that's what market makers are there doing, right? They take it from different parts of the curve and they sell it into these guys' positions at the prompt. But also, I think a good anecdote or good thing to explain is that ever since WTI Midland has been put into the dated Brent benchmark to be settled, what happens is, again, most traders don't care about flat price. They immediately hedge their flat price. So what they're doing is they're trading the differentials because they're moving it from one region to the other. So if you're buying WTI Midland and you're selling it as a dated Brent cargo, your hedge, if you're doing that in the future, is to buy WTI Midland and sell dated. So you've got a WTI Brent implied position. You get rid of the WTI Brent leg, you're actually left long DFLs. So you're long dated Brent on a physical basis and short the Brent. So that is the DFL differential. So just from all that physical flow that you're doing, so Trafigura and Vitol, huge importers of WTI Midland into the dated Brent benchmark, into Europe. Lots of other players as well are doing it. They always have an implied long position. So actually, when they're selling, there's no indication of anything. It's just they're probably wanting to lock in what they've got on the long side, just hedging, just generic hedging, whatever it is. So in addition to what you're saying, the executed flow being bullish, people having been long and then making money out of that derivative flow, they're also making on their implied position, which has come from the physical pricing. And that's how these guys make so much money, right? They've got these contracts and they're able to play the result of those physical contracts, the result in implied derivative positions, and they manage it off the back of that. These things can make an incredible amount of money. So again, if you're arbitraging barrels in and you've got things in the contract like operational tolerance or options on where things are priced and all this clever stuff, they're getting a head start. So if you're getting a head start being long DFLs like 20 cents below where the market is, it's not too hard to run that position if you're bullish. And then everything's now rallying, they're having a great time. So yeah, I think North Sea having a ball is probably the right thing. So definitely a gold rush. That's a good one. And off the back of it, the Brent spreads, the Brent time spreads are quite linked, and they've been performing as well, although they have been very choppy. So I wouldn't say that that's a massive gold rush. I would say the general financial market probably hasn't been participating in this rally, but the North Sea players almost certainly would have been. Okay, now let's look at who's been losing money. This is the Widowmaker.
Okay, on the Widowmaker side, so we can start with a generic one. On the August Brent futures, as seen in the chart, we're going back to it. Prices gapped up on the open on Monday, so very much up from 62.
Well, having been panicking right on the Friday, so I think is this the day itself?
So this is from Friday to Monday.
Yeah, Friday to Monday. So yeah, as you can see, like towards the end of the day, all the headlines coming out, people probably not wanting to leave their books long in the back of this OPEC stuff that was coming. There's a lot of selling, but yeah, then that maybe triggered some discretionary selling, some trend following, or just some hedging from the option market makers that then overnight had to be unwound. So yeah, you're absolutely right. That for sure would have led to some lost money there.
Yeah, that's very much a short-term one. On to the oil swap side, something more niche would be looking at the Naphtha, European Naphtha. This is the June-July spread. So it's fallen from like $10 at the start of May till under $5 going into pricing.
Yeah.
And at the same time, the June-July crack roll has come off below flat. So that's into a small contango. So indicating potentially a supply glut in European Naphtha in the prompt in the physical. That's also off the back of, you could say, weak petrochemical demand, but also more US C5 cargoes arriving into Europe, and they are struggling to clear. And the fact that you also saw open interest come off in June as well, so showing that people aren't willing to own length in June and rolling their length into more of the deferred months. So previously Naphtha was quite bullish. You guys are saying that it was still very stubbornly quite strong, but at least in the front, in the physical, you can see there's been movements and things have been quite bearish. The supply glut is here, and that's led to a large sell-off in the spreads.
Yeah, I think it's worth noting as well, because we have talked about it on previous episodes, that the naphtha market's been strange in that it's been long the time spreads and short the crack as a general kind of industry. So they were profiting quite well from the time spread, and that maybe that was holding up the crack. But now that the time spread's starting to weaken, the crack's starting to go as well. So it's a weird one, because the time spreads, I see what you mean. There's some bulls out there who probably most likely getting burned. But with the crack going lower, I actually would say that the industry is doing okay, actually, and making money from naphtha cracks. And again, going back to the refinery margins, it was kind of driving me a bit mad as well, because how can fuel be strong and naphtha be strong and so sustainably? This is either an indication that the market can hold itself up for a time, and especially looking at it in like bonus cycles, like Jan to Day, kind of May is like, well, they've got all their bullets and some of their bullets, and they've done a decent job of propping things up or whatever it is. But then as you get more towards the end of the year or the second half of the year, kind of the chickens come home to roost, right? And it's a bit like the supply that really is coming online from all that propped up markets can lead to real physical supply, which leads to a bearish momentum, which does seem to be happening. So the market's turning rational, starting to give indications that it's turning rational now. You can't really have a light end of the barrel really tight and a heavy barrel really tight unless it's an unbelievably bullish market. I don't think we're that bullish. We're meant to be building. We're meant to be oversupplied. But this is kind of been the theme of today's episode. But if it is starting to be more rational, naphtha's weakening, again, going back to fuels weakening, then yeah, the trend could be set for the rest of the year. So anyway, I was kind of stealing your mojo there, but you get what I'm saying. And was there anything else in the Widowmakers?
No, that's just
the main one.
Naphtha and the Brent.
I mean, what's your sense other than that? I mean, we had quite a bit of chopping and changing in the first, let's say, 3-4 months of the year, and then it died down. And we're kind of actually struggling last week to even come up with a key outlying trade, because everything seems to have had its move. But this does feel like the beginning of a new trend in the refinery margins. Would you agree?
Yeah, especially as the refineries come back online, coming back for maintenance, looking to take advantage of these strong margins, right? So as naturally you would see a seesaw effect, more product coming online, leading to stock builds, pressuring on the margins. So
it's almost like the market's had its fun, and now things need to actually make sense, or something needs to give, essentially. You agree? Anything
I would
else?
agree. I think there's only so long that margins can be so strong across the board. As you said, you have the heavy end and the light end. Normally you'd expect some kind of again, the seesaw effect again.
Well, like 2022, for example, right? Even in the most bullish market the oil market's ever had, we had this huge rally in gas oil cracks up to $40, and gasoline was $40. It was like, it was just something had to give. And that's the weird thing about refinery margins. It tends to like something, keep saying seesaw. So gasoline gave. And it was obviously still really high historically on a crack basis, but relative to diesel, it completely gave back. So that's even in the most bullish market, you get those things. But for everything to be bullish, when you're meant to be oversupplied and OPEC are meant to be increasing, and look, maybe you could actually blame the consumer hedging, because the flat price sell-off in April was so aggressive so quickly. Like if one day you're driving, are your driving habits going to change, or your flying habits going to change day on day? No, they're going to take like a few months, a year, whatever, with the economic cycles and all that. So flat price came off so aggressively. Suddenly airline fuel's cheaper. Suddenly shipping fuel's cheaper. These guys were like, well, literally, we're selling, ticket sales aren't just going to drop with it. So they rushed in and bought everything. And almost every consumer hedger that was available to hedge looked like they were active. And that has lent a lot of buy-side derivative volume, which has probably gone away to keeping prices elevated on the product side. Because it's not crude. The only ones that can buy crude are either people who buy it for power generation, which is like less than 1%, or refiners, but they're buying on a diff basis. So the consumer hedging on the product space can be quite influential on a flat price basis. And maybe that's why. And now that they can't do that trick twice, right? If it does weaken now, we've had a period of sustained weaker prices, and they've probably hedged an incredible amount. You're not going to get anywhere near the same kind of buying rush for the second half of the year. Yeah. So maybe that allows it to give way, basically.
So if things give way, then like the sell-off could be even quicker than what we saw.
Well, there's no one who's left to come in and buy. If they've already done all the buying. They can't just do it forever. There used to be a thing that when we broke psychological levels, the Chinese would come in and buy and build inventories. But they've also already done that, right? I mean, how long can they do that? And it actually brings about like 2014, like my second year trading. And sorry, I think it was my second year. Yeah, I think it was. And, we've been bearish for a while. And it was like 114, so it comes lower, comes to 100, and everyone's like, yeah, you can't be short here because the Chinese are going to come in and just buy a shitload. And I think they did, but it couldn't hold up forever. And it's still like, obviously the market was so oversupplied with shale oil and all that kind of stuff. So all this talk about Chinese buyers coming in and draining the inventory, draining the oversupply and putting it in their inventories, it's just like flash in the pan type stuff if you are actually oversupplied.
It does make me think about the Dubai window though, because Dubai structure makes you move in monthly cycles. And last month we had a lot of PetroChina buying. They bought a lot, particularly Murban cargoes. They got nominated. That was part of the whole Dubai debate problem. But then as of yesterday, the new June cycle, PetroChina has disappeared from the buy side. And there's very little buy side interest in the first window. That can happen at the beginning of the month. It's quite cagey. You're trying to work out what's the lay of the land. But the spot market and Dubai market is quite often where China will go for opportunistic low flat price buying. We saw that, we've seen that before in the previous months. So if they're not there in the Dubai market, who's there to prop it up? And that's going to be the next question we have to solve in the next few days.
It is a good point. And it was also a conversation we were having a couple of weeks ago, or maybe last week, where we were saying that the Murban oversupply, basically incremental, it's made even worse in the market, if you like, by having a physically delivered contract. Because if you can't get rid of the Murban and it's starting to set the Dubai benchmark and you really need an outlet, well, you can just go on the screen and just all the buyers that are on the screen, just give it to them because it's physically delivered. So that's why WTI, I think, as well as it being landlocked as a crude, being in Oklahoma, when there's oversupply, WTI is always the one that's way more vulnerable in an oversupplied market because you can just give the market the volume just a few months ahead. So if you know you've got all the loading and you know the market can't take it, well, you're not going to find a buyer. So you might as well sell the futures and make it someone else's problem. So that makes it a very highly susceptible contract in oversupply. And I don't think Murban's any different, really. I mean, it kind of launched in a relatively small fashion, not much was going on. And then we went on like a 5-year bull run.
Yeah, it was 2021. It was immediately before the massive global rally. So
if people say, oh, well, if it was going to be susceptible to a sell-off, it would have happened already. It was like, well, no, not in the most bullish market ever. So I think now it's going to get tested. Well, it has already get tested. How it has already been tested, and it's forced the Abu Dhabi guys to start.
I think it's failed the test.
It's failed the test so far, in terms of its ability to hold up to oversupply, you mean?
Yeah. In terms of deliverable problems.
I mean, I hate physically delivered contracts. I mean, because we trade and we don't like the physical overhang, but it means you're always worried about taking supply at the very end. Like you get the call from the banks like 2 weeks out, like, what are you doing with that 2 KB, futures position that's going to be physically delivered? And you're like, for fuck's sake, like, this is so annoying, the admin around it. It's just, if you want high liquidity in like well-functioning markets from a price discovery basis, cash settled is the way to go. But I understand why people think physically delivered is the better way to go because it actually relates to something. But I think the problem with that is you need physically delivered contracts for everything and for everyone to be participating at the same time for that to make sense. It's basically going to be imperfect until it's perfect, and you'll never have a perfect market. So I think that I'm just not a fan. But anyway, as you said, it's not really stood up to the test. But anyway, having said all this stuff, we've got to talk about what's going to happen next. This is the crystal ball. So let's just rattle through them then. Brent futures, Brent time spread, gas oil crack, gasoline crack. So starting with Brent futures, Vincent, can you get like a technical chart?
Mm-hmm. Yep.
You should be able to do because you passed your exam. So you knew that was coming.
Surprised it took this long.
Surprisingly, but
okay.
So on the Brent crude future side, we have the prompt month technicals. So what we can see is very much a consolidating market, despite the short covering flows, despite the volatility over the past week. If we look at this grand scheme of things, there's not too much going on in price action. It's been trading at a lower $2 to $3 range. Even the rally on Monday was just within this $2, just within $2, around 65-ish. $60 seems to be, it is a psychological support level, but prices are also struggling to get above the 66, 67 region. So we see a symmetrical triangle, the two lines converging, which means potentially there could be a breakout onto either side. But overall, in the medium term, Brent is going towards a low volatility.
And give me some more technical jargon, right? I mean, like you've post-exam, you should be flooded with it.
Well, if you insist, we can talk a bit more.
By it.
Yeah, symmetrical triangles. We have that's the one. Bollinger Bands are narrowing. What do you see here? The MACD histogram. That's the red and green bars at the bottom. That's coming down ever so slightly. So in that sense, the momentum is weakening. So if we look at things from a weekly perspective, there's less. Brent is not really heating up. It's kind of the momentum's weakening. It's sort of dying down before people are waiting before the next big move, next big catalyst.
Yeah, it's just so hard to have a good bullish narrative on a risk reward basis, because if you're going to buy at 64, 65, given how volatile Brent is, you're kind of looking for at least a 2-to-1 risk reward, and the volatility means even on a medium term basis, you've got to have at least $3-4 stop. So you want to be making $8-10. Are we going to be getting back to 75 like last year? I just don't think there's a good enough story unless there's a huge geopolitical event. It just doesn't seem likely at all. So any rally being quite exhausted quite quickly on a momentum basis does actually make sense. But on the flip side, obviously there's lots of protection on the downside, and you've got like an engaged market always trying to prop up the market. That's like the market's MO. So I get why it's in a range. It actually makes complete sense that the psychology of the market is playing out in the price action. And I guess that's the whole point of technicals, right? So symmetrical triangle. Yeah, sounds like a kindergarten thing. But, send you back to kindergarten. All right, so hang on. So are we bullish or are we bearish?
Leaning towards bearish. I think given that it's struggling to break above 66, and given all the bearish fundamentals, OPEC are going to keep on increasing supply. At least we struggle to see a reason to be more bullish.
Okay. Ed?
I kind of agree, although the one offsetting factor would be the geopolitical aspect, because I think the prospects for Iran and Russia-Ukraine coming to some kind of a deal have decreased.
You're just repeating what the market thinks, I think. We both are, right? It's just like there's bullish and bearish arguments I don't know. But that's why we're forced.
That's the problem with the market.
Yeah, but that's why we force this binary bullish bearish, right? If you have to pick one.
I think I'd be more bullish. I think it's shown quite a strong resistance.
Jorge's bullish at the moment. He's telling everyone to buy flat price,
Jorge has his own little game going on. But no, I think it's shown quite a strong floor. It's, I think, struggled more to get below 64 than it has struggled to get above 66. So I think there's potentially more upside there.
I completely disagree. It's just completely struggling to get back up 66, but that's the market, as you say. That's all good. So let's do so I'm bearish, you're bearish. Okay. And the time spread, Brent time spread.
Yeah, Brent time spread we got on the screen. This is the August versus September. That's the prompt time spread. So again,
this is a peak summer spread, right? This is the last chance the market has to reflect summer demand for the Brent time spreads.
Yeah.
But it's already had such a good rally, but the momentum's quite clearly with it, no? I mean, that's what you're probably going to say on a technical basis, no?
I mean, there's bullish momentum, especially with the data rally, that's also they've been supportive of each other.
Yeah.
So it's showing prompts very, very tight backwardated market in the front. But at the same time, there's high volatility on the way up, but the last 2 days it's come off a little bit. So there's definitely a bit of resistance at the 80 level.
Yeah.
So we need to see more people come in, more like another bullish run, a more bullish physical North Sea market to see prices go up.
I think on the trading corner, like Manny always goes on about this graph that we've got actually up here, which is refinery margins versus the DFL, and you overlay them. And you see they've kind of converged, which is very logical, right? So the refinery margin is high, the DFL should converge with it. It should get stronger with strong margins. That has now happened. And now it almost looks like it needs to reverse again. So we've actually probably likely to see a DFL sell off as margins keep selling off, if margins keep selling off. So on that basis, because there's nothing else I've really got, I would say, it's just had its rally. It's kind of exhausted. You've probably, like you said, it was the gold rush, right? And you know, if you're a trader, you've got to focus on your exit sometimes as much as your entry, and certainly your stop loss. You've got to be thinking, like, when is the right time to take the money? Like, if things play out early, well, it's a futures market. It's a reflection of the future. So ultimately, you get it priced in when you get it priced in. You don't have to take it all the way to the end. And actually, if you get a rally early and you can take it off and not have to worry about the physical, that's actually quite a cool scenario for the North Sea guys. Like, oh, great, I don't have to spend a fortune, on physical and the window and moving stuff around. I can just take profit on my position and move on. So I think we're getting to that kind of territory now. So I'd personally be a bit more bearish, but want to conclude it? Bullish, bearish?
More bearish, I think. Yeah.
I think, bearish on the spreads.
Nice one. So cracks, we've got gasoline and we've got diesel. Let's rattle through this, run out of time.
Yeah.
Probably just, trading with the momentum. I say hope. It's not like I'm emotionally invested in these two things, but it just, to me, everyone wants a rational market. And I think we've been waiting for this distillate sell-off in particular. It's starting to kind of come in a little bit, and gasoline as well. I think they just have to keep going. They just have to keep converging and get to more normalized levels on a refinery margin basis. So I'm just going to maintain that. Did you want to say anything on a technical basis?
On a technical basis, it's still more range bound.
This is gasoline, or
this is gas or crack, distillates.
Distillates, yeah.
On the diesel side, very, very much a range bound market since the start of the year. Since March, really, the bottom has been around $14.50. So as much as people think despite people might have a bearish view, but I would say in such a range bound market, you would only really it's only really much a one to watch if prices fall below previous support levels around 14.50. So there's been a trading range. If it falls below, then there's really this could give a lot of ammo for the bears to come in and add more short positions. Maybe it will trigger a lot more stop outs. So it's definitely a one to watch, especially if prices break above or below its recent trading ranges.
Yeah, I think I'm more bearish on the Asian gas oil market, partly because of the Upper Zakum increase in exports and the overall availability of that kind of product that will probably yield. So I think on this one, I'm more decidedly bearish.
It's just that, going back to that Seesaw thing one more time, we've just looked at distillates and gas oil, and I guess we'd add fuel to that because of the Eastern strength has been where things have been led for fuel. And if that does start to unwind, and this is the kicker, right? The Al Shaheen switch and more heavy supply of Fujairah, things like that, then the Murban is coming off the market. That's the Naphtha yielding one. The Naphtha sell-off is probably under threat, because if everything else is going to weaken and crude is going to potentially weaken, then actually Naphtha versus Brent is likely to be supported on that basis. So theme of the podcast is Seesaw.
Yeah.
Okay, let's leave it there. Thanks, listeners, as always, and remember to check out Flux. Check out flux.live, glossaries, information, articles, all the rest of it, and access to our Flux terminal. You can trade all these contracts we're talking about on onyxmarkets.co.uk. Remember, there is no limit to cash. Put in 20 quid, 50 quid, depending on the limits. I'm pretty sure you can go that low. So check it out no matter who you are, and hope to see you again soon.